Hello, my name is Bridget. I will be touching base on Chapter 8, Lesson 1, the review of the taxation of property dispositions. An overview of the chapter is going to look like this. It's going to touch base on realized gains, losses, what transactions are included, when it cannot be realized, and what person engages in a transaction. It's also going to touch base on section 351 when we go into lesson 2. That is also what's going to be included in the slides. And lesson 1 is going to be short because lesson 2 really defines those definitions we're about to go over. So realization occurs when a transaction takes place. This comes before recognition can take place. So before I can recognize a gain or a loss, I have to understand what my amount realized is and the adjusted tax basis of the property transferred. That is how we're going to compute our formula. An entire amount of gain or deductible loss realized is recognized unless otherwise provided by the IRC, which is the Internal Revenue Code. It would not be recognized if it is excluded from gross income, so a corporation does not include it, or the corporation is deferred from gross income. So they postpone deducting it or adding it into their gross income. Now here is the formula for amount realized. It gives you different components that will allow you to then plug that back into our formula here that subtracts the adjusted tax basis from it. So the tax basis is going to be an asset's carrying value for tax purposes at a given point in time measured as the initial basis improvements less depreciation or amortization. So realization is going to be when transferring cash and non-cash property in return for stock. So that's going to be the transaction that we are allowed to realize when we are computing our gain or loss. So when a shareholder transfers that, they can receive stock in the corporation in return for that property, having collectively control of the corporation after the transaction. So basically, if someone has property as their control in a corporation and they want to exchange it for stock, they then have to have ownership of 80% or more of the corporation's voting stock and 80% or more of each class of non-voting stock for purposes of section 351. This kind of ties into the control test. And in my example here, we see that they compute the amount realized by only adding the mortgage assumed by 360 Air. Now that's because if we go back to here, it shows the liabilities assumed by the transferee on the transferred property. A mortgage is going to be a liability that person is now taking on. So they're going to use that in addition to the market value of the stock that they're being received. Now, if you look at the table right here, it shows $375,000 as the fair market value. However, when we're looking at what the net gain or loss is going to be realized, we have to see what will they be getting out of this exchange. So stock can be common, preferred, voting, and non-voting when it comes to an exchange. So if I were to realize this gain, I would then take either a deferral on it or realize it right away. So in order to remove a tax consequence, Congress justifies a deferral because shareholders maintain an interest in the property transferred through a different form of ownership. So my ownership of that property is now going to be stock property instead. So I still have an ownership in the corporation. The exchange of stock received from transferring property that can be a gain or loss deferred is reflected in our tax basis. So right here, it says adjusted tax basis of the property transferred. That is not going to be what we're talking about when we talk on the tax basis from the gain or loss. So with deferring a gain, the stock basis will be lower than the fair market value of the stock by the amount of the gain. And subsequently, deferring the loss, a stock basis will be higher than the fair market value of the stock by the amount of the loss. So if you look here, my example, we're going to take this $200,000 gain that we have realized from our amount realized in the fair market value added to the mortgage as listed here in the equation, and then minusing the adjusted tax basis of the property transferred. So we're transferring this property here, the inventory, building, and land, and our adjusted basis on that was 175. So that's where that number comes from. And if we take the fair market value of that, since it is a gain, we then have to subtract it from that 300,000. So our answer would be 100,000 since it was deducted from our FMV to arrive at that tax basis. So for section 351, it's going to classify a portion of the property exchanged for stock to qualify to be a tax deferral. As mentioned earlier, stock can be voting, non-voting, common, or preferred, but does not include stock warrant, rights, or options. Property in exchange for debt is not eligible under 351. And to be eligible under 351, certain requirements do need to be met. Unfortunately, it's not as precise as we would like it to be in either the code or regulations. So for now, the parameters of the section 351 has developed over time as the IRS and courts have interpreted the law. When requirements are met under 351 transaction, it is mandatory to defer a gain or a loss. Property other than stock received by the shareholder is referred to as a boot, and only gains can be realized on the exchange, so it does not include in the 351 purposes. It would be separate than that because a 351 has to have stock in the exchange being transferred from property. So if I were to give property in exchange for 50 shares of stock, that is what could be under 351, and that gain or loss could then have a mandatory deferral either in the near future or not deferring at all. Now, the code defines what a person can be, and that could be either an individual, a corporation, a partnership, estates, and trust. Now, property included can be money, tangible assets, intangible assets such as company name, patents, customer list, trademarks, and logos. Services are excluded under section 351. So if you're trying to have a mandatory deferral, it cannot have that if it's a service being exchanged. So if I have, for example, $125,000 worth of services and $300,000 worth of property I'm trying to exchange for stock, it's not gonna include in my section 351. It actually could still be included in a gain or loss realized and be a transaction in a property if it meets the relatively small factor, which is 10% of the stock being exchanged. Now, in order to understand ownership, we look at ownership through the control test, and that is going to be 80% or more of the corporation's voting stock and 80% or more of each class of non-voting stock for purposes of defining after the transaction what type of control in the corporation there is. So this section was relatively short, very to the point. It sums it up in order to get gains or losses realized. A transfer of property in exchange for stock can be deferred. It talks about section 351 and how gains or losses are deferred in that. What establishes ownership in a company, and the value of property exchange must equal at least 10% of the value of stock received for services provided.